Welcome back to some more property chat, everybody. Today we've got Ross Pocock, the man, the myth, the legend from Sternlight Financial. He's a weapon of a financial advisor. So Ross, how you going, brother?
Good, thank you for having me today, and thank you for the very warm welcome.
Oh, of course, mate. And tell me this, for people who don't know you or potentially don't even know what a financial advisor is, what do you guys actually do, and who are the type of people that you help out the most?
Yeah, definitely. So I would say the best way to describe a financial advisor is someone that is designed to help you achieve your financial goals. So that could be anything for anyone. So some people, it might be they just want to go on a holiday every year, and it's around budgeting. For other people, it might be they want to purchase a second or third properties. Other people want to get into investing or growing my super in a different way. So it really varies, and we're holistic advisors, so we look at everything in that aspect. We don't just focus on one area, and it's about maximizing what you have remaining. It's not about being on a tight budget, which is probably one of the biggest misconceptions. It's not about narrowing down your lifestyle now, it's about maximizing the remaining afterwards.
Gotcha, yeah. And we can chat about the property stuff in a sec, but I'll just ask you this as well. When do you think is the best time for someone to come to a person like yourself, a financial advisor? Because I feel like a lot of people, they get to, maybe their mid 40s, their 50s, and they're like, oh crap, we're retiring in 20 years or less than that. And they realize, oh, maybe we should have actually started sooner. So for someone who's maybe early on in their journey, maybe early mid 20s, when would you say is the best time to come to you guys so you can have the best chance of, setting yourself up for the future?
Yeah, definitely. So, look, I would say the best time to talk to a financial advisor is when you are looking at your finances in a sense of, I know I want to achieve something. So that could be, everyone is at different stages of life. I know myself, when I was 18 years old, I wasn't worried about the financial future. It was about going on holidays and traveling. So that person might not be at the time the best suited to go to one, but it's when someone actually sits down and goes, I want to maximize my position. The earlier you do it, the more likely you can achieve your goals sooner. And I want to grow my wealth. That would probably be the best time. What we tend to see is you're spot on. It's around that age 40 is when a lot of people go, oh, I should have done this sooner. Whereas we see clients at around the age 28, 29 who have far exceeded their peers because they've gotten onto it earlier rather than making those mistakes to then see someone.
Sure. And is it like that a lot? Like people come to you with a goal and say, hey, I want to build up, it might be 10 properties or it might be, I don't know, $5 million in assets or whatever it might be. Is it easier when someone has a clear goal rather than just coming to you and saying, oh, I want to, make a bit more cash on the side? Does that make sense?
Yeah, no, definitely. No, look, to be honest, it's not even about those levels of numbers that you mentioned. When we do our meetings, we do a goal session. So we sit down, because people will, if we look back 20 years ago, we had a scenario where there was not enough information for people to understand what to do. We now live in the world of Instagram and things like that, where it's information overload and people don't have a direction.
Everyone's a coach, right?
Correct. So we look at that and go, well, in that goal session, we often get someone come to us saying, I want to build wealth. And it's like, cool. Well, then we narrow that down. Why do you want to build wealth? When do you want to achieve that goal by? How do we achieve that? There's multiple avenues. And then we break that down, and that's how we formulate the goal for the client. And that can vary from building wealth to making sure they're protected from their family for insurance. It varies.
We work with a lot of people who, want to build property portfolios, maybe want to grow up to 5, 6 property investments, maybe diversify into some stocks or, keep their doors open. What's the benefit of working with someone like yourself as well, compared to just going it alone and then not using an advisor?
Yeah, definitely. So one benefit there is I very much, we're like a web. So if you go to an accountant, their main focus is to reduce your tax. They might pull strings, but it could lock away funds for that. If you're putting funds into super to claim a tax deduction for it, cool, that's great. long term,
Yeah.
but if you want to retire by the age of 50, you don't have access to your super.
Yeah.
So that doesn't necessarily fit with your strategy. So it's about, where we do is we kind of piece together all the areas, and then in kind of more recent times, it's also about avoiding mistakes. So if we look at what's happened in markets recently with Trump tariffs and things like that, there's been a lot of hesitation, and these are the times that people will often go, oh, it's not working for me, and they pull the funds, whereas they're locking in certain things where it's about education and understanding to help them smooth out the volatile times, and then get them into that property, the second property, get them into investing, and having that broad diversification, so they're not just going down one avenue. The old saying, not all your eggs in one basket.
Of course, yeah. Do you think, I'm a bit of a side note, but do you think a lot of that Trump tariff stuff is going to affect us like here as much as people, the media's sort of saying, and it's going to burn the economy or whatever they say? Do you think it's actually going to have an effect, or?
No, not really. It will have a effect. Everything has a knock-on effect all the time. There's a big saying within the industry that when America catches a cold, the rest of the world sneezes.
Sure.
And that's what we're seeing in these reactional markets in these times. But it's about understanding the fundamentals of it. And if you invested in a company 6 weeks ago, how has that company changed in the past 6 weeks? A lot of it hasn't fundamentally changed. If you've got a diverse portfolio, there's small sectors that have, but the overall market dropped, and they're the things that it's about education.
Sure, yeah.
So long term, no, I don't think it will. We've seen everything is a once-off event. COVID was a once-off event. GFC was a once-off event. These Trump tariffs are a once-off event. The Gulf War was a once-off event. Everything is a once-off event that seems to repeat itself constantly.
Yeah, it's always funny looking back at these events as well, right? I mean, look at COVID. Everyone thought the market was going to crash and burn, and then it's probably one of the biggest booms we've seen in a very long time, especially here in Queensland. In
Queensland, properties gone crazy, yet people were selling their properties because they thought that everyone would lose their jobs and the value of the properties would go. But fundamentally, it was a 6-week window, and the panic that caused, unfortunately, cost a lot of people money, their homes, deposits, because it created that panic there when it was very short-lived. And yes, again, like I say, COVID was a once-off event, but these once-off events happened every 2 to 3 years.
The once in a lifetime, right? There's always something.
Exactly. So that's where it's important via the education around what it means on your overall situation and how it is personalised to your event. I use as a big example at the moment, we've got the news. $1.6 billion wiped out of people's superannuation funds already, and that is there to create fear. But retirees are often the ones that are panicking in these situations. But with a true diversified and a portfolio designed for their situation, they very much saw hardly any drop in their portfolios if it was designed properly, because it is a broad diversification, and they shouldn't be in those super aggressive assets, or only a small portion of them. So when these things happen, it balances out. But the media likes to create that fear, and unfortunately it causes a bit of panic, and that's where an advisor really earns their key.
With all the super stuff, would you say it's more beneficial to set up your own self-managed super funds, or is it better just to put it in one of the major super funds, or what's the differences between the two, and how can someone maybe benefit from setting up their own self-managed super fund?
Yeah, definitely. So there's actually kind of 3 avenues there that people don't realise. They see your standard standard super funds, which are the ones all over the TV, the ones that you automatically get put in when you start an employer. You've got your self-managed super funds that you're talking about, and then there's there's funds in the middle. These funds in the middle they do the admin, but you can choose your own underlying investments without having to go down the self-managed super fund route. Now, in saying that, self-managed super funds hold a huge amount of benefit if you are looking to purchase property, and I mean real property. You might look at commercial properties and things like that, physical gold bars and things like that. This is really where self-managed super funds come into play, but you do have to be careful with self-managed super funds because you do lose a lot of protections around it, which is why there's a lot of risk involved. But the main focus around the self-managed super fund is if you are looking at purchasing an investment property. And I highlight investment property bit deeply because we all see those ads on Facebook, Instagram, where it says, buy your first home using your super fund. You cannot buy a home to live in with your self-managed super fund. It is an investment vehicle for retirement, but there is huge benefits with using it if you are looking to grow your super through owning physical property.
Exactly, because I think that's the misconception, right, is that people think, I can buy it in my super and then either live in it, but then what they don't realize is, well, one, you can't live in it, but then two, you don't actually see any of the gains, right? Because everything from that property goes back into the super. Is that right?
Correct. So look at superannuation, it is a retirement vehicle. So you personally cannot see any benefit today. It is designed for retirement, so you cannot live in the property, you cannot receive rent personally from the property, you cannot have family members living in the property. It is all done, the general term is arm's length. So you purchase an investment property, you run it for a real estate, everything is kept within that environment. If you sell that property, the gains and everything is kept within the super. One massive difference between a self-managed super fund and owning property personally is tax deductions are kept within the super fund. That is key. The second part is the CGT is done at the super fund tax rate. Now, if you sell that property in the first year, the tax rate is 15%. If you sell that property after 1 year, you get your CGT discount, which inside super is 33.3%, so it works out to be a 10% tax rate. If you sell that property when you are retired, your retirement is a 0% tax rate inside a pension fund. So you could potentially own a property, see the capital gains over a long period of time, and as long as you don't, if you sell it when you're in retirement and your super fund is in pension phase, it could be a 0% tax on that sale.
Which is massive, right?
It's huge. It makes a hell of a difference. The only thing is when you're getting close to retirement is your liquidity needs, which is a big factor.
And taking it back a step, sort of going back to the younger people, looking to build up their wealth potentially, what's probably the biggest thing that you see is holding people back from growing your wealth, whether it's, buying an investment property or whether it's building through stocks or some of the other avenues? What's the biggest thing that's holding people back at the moment, you think? Or the biggest mistake that they're making?
The biggest mistake, I would probably, it would probably be broken down to 2 or 3 mistakes. One of them is not getting started. It's I really want to do this, but I don't know where to get started. So it's very much about not actually constantly talking about it, but then 4, 5, 6 months has gone by because they don't know where to get started. That's probably the biggest one. And then the other one is, and it's unfortunate, but depending on your situation, especially the younger generation, they might not be fully established in careers yet, so income's a bit lower, but the cost of living is quite high. So often it's about that compounding effect over the long period. Unfortunately, one big weekend, one big holiday can knock back 6 months worth of work without realising how close they are to achieving that. There's quite a lot of interesting stats coming out at the moment, which is if you want to achieve $1 million, the first 10% of that to achieve the first 100K actually takes around 26% of the time. Just to achieve that first 100 because of that compounding effect. So it's about getting started early and taking a keen interest and actually getting started.
And I think it comes back to the reinvesting as well, right? Like you look at, what do you say, 26% of the time?
26% of the time takes to achieve the first 10%.
And it's like, well, if you saved up 100 grand and then you just go buy a car, Well, it's like then you have to work equally as hard to get back to that place, right? Rather than letting the compounding do its thing.
You're spot on there.
Yeah.
So you have to work equally as hard to get back there. And then on top of that, I would actually say often you have to work a little bit harder because you've got that new car, which is generally more expensive on insurance, more expensive on everything around
on finance as well.
If you go finance, often
yeah.
we see that. You then have to get that paid out because it affects your borrowing capacity. So those small decisions can have a lasting effect. I saw it personally. I knew nothing about finance. When I turned 18, I got cars, I went traveling, I did it all on credit cards.
And you still did alright, so that's all good.
And it wasn't until I got serious about it, I actually went to university to learn about it.
Sure.
And I understand there's a privilege of being able to actually go to uni. But I went to university to learn about it. I knuckled down, I got all that paid off. And then I got into financial planning to help people not make those mistakes. And that is the biggest factor there.
And I know you mentioned something about cost of living in there. And obviously we're all affected by it. You know, our eggs cost us $12 now, or and your Macca's meal costs you $20 compared to $10 a few years ago. But then equally, I also feel like a lot of people's spending might have increased as well. So what's your thoughts on cost of living crisis versus, you know, cost of spending crisis, where people are out actually spending more? And do you think people are still willing to save as much, or do you think the sacrifice component has been lost a little bit, or what's your thoughts there?
What I see an awful lot in the industry is people going, I can't afford this anyway, so I may as well spend. The cost of living, there's no doubt about it. You go to the supermarket, you get a basket, it's $100, whereas it used to be a trolley was $100. There's no questions about the cost of living, but often that has caused people to be disheartened. And they go, well, I can't afford it anyway, so I'm just going to spend it as much as, and that is what we really see reiterated often, or well, I may as well buy that car because I can't afford the house anyway. Whereas it's about smart strategic stuff, and that people often just look at their bank accounts. The banks are offering 3 to 4% savings, whereas you can get much better with a strategic plan in place to help you achieve those goals sooner.
Because I think people don't quite realise what they can actually do. They just sort of write everything off. Like even these days, you know, there's so many government incentives with the 5% deposit, no stamp duty. I'm pretty sure, depending on what goes on with the election and everything this weekend, there's going to be, you know, incentives that, you know, there's going to be no purchase price cap on your first home, right? So it's like, well, you could actually buy $1 million house for, you know, what's that, 50 grand, a 5% deposit,
Potentially, and these are all things that are coming in now with everything to do with a lot of these government schemes. Unfortunately, they do also drive up prices because someone that was selling to a first home buyer trying to keep it under 750, if that's now raised, now they're pushing it to 800. So it does have a reactional effect, and not all of it's been passed. They are promises at the moment. So, but you are spot on. There's lots of schemes in there. You've got first home super saver scheme, first home buyer scheme, 5% deposits, no LMI. They're talking about the government co-ownership. These are all the schemes available for people to get into their first home, which are often, again, loads of information, not understanding which one is suitable for that person.
Exactly. And I think, you know, everyone talks about 5% deposit and stuff, which is great, and it helps the barrier to entry. But then there's also the serviceability part, which I think people fail to mention. You know, it's like looking at some numbers, and even if you buy like a $700,000 house, 5% deposit, you still have to pay that loan back, right? And like the loan you're going to pay back on or the interest you're going to pay back on a house that's worth $700,000-800,000 is going to be over like $1 million over the 30 years, right? Which is, you know, almost pretty much more than what the actual principal of the property is. So you got to look at those few different things and actually size it up and say, hey, is, you know, maybe owner occupier, is that the best strategy, or do we do something like rent vesting where, you know, we live somewhere else and then we buy an investment property to help offset the costs, and be a bit more creative these days, right?
You do. You are spot on there. You do have to be a bit more creative now. One strategy that often comes to mind here, and it's not suitable for everyone, this is not advice, you do have to seek professional help because it is a complicated strategy, is one called debt recycling. Now, I'll give you a bit of a case study here. I have a couple of clients, they came to me when they were 25 and 26, have just purchased their first home, lots of debt on their property.
Sure.
Now, I will highlight they're both teachers, so they're kind of like, they're not high executives earning millions of dollars type thing. They're your everyday families. They've got one son. Came to me 25, 26, we put a debt recycling strategy in place. They are very good at saving and things like that as well. We're estimated to have their home paid off by the time they're 35. So they came to me 25, 26, they're now 30, and 30, 31, and we've got 3 to 3.5 years left to have their home paid off. That is huge, and they're the sort of strategies that we can utilize to not only reduce that debt, build wealth, and get them, if they want to go to the next investment property, get them into that, or alternate ways.
Sure. Yeah, so a lot of financial planners, they don't, touch property, and they sort of go more towards the mutual funds, the stocks, the bonds, whatever. What draws you to property, and how, or let me ask you this, why do you find a lot of them don't go to property, if that makes sense?
Yeah, definitely. So look, property is a cornerstone of a lot of Australians' wealth. Property prices have been going up consistently in Australia. We've got a very low supply and a very high demand. Why do I think a lot of financial planners avoid property? And I think it has to do a lot with when it goes wrong, it can go wrong quite badly. So I saw a stat recently, and I haven't delved into it. But 1 in 2 units in Melbourne have lost money in the past 10 years. Now that is quite an alarming stat, and when you're talking the purchase prices, that can be quite scary. So I think a lot of financial advisors try and err on the side of caution with that. However, I believe financial advisors should be looking at it, because it is a cornerstone of wealth, and it is important that you build a team around you to be in contact with people like yourself who understand the property market, who then go, cool, let's go to property, and you've got all the key pillars of wealth. You've got cash, you've got stocks, you've got property, you've got your home, you've got your superannuation, and you may have your own business in that sense. You have a diversification, so when property markets are a bit flat, you've got your stocks going well. When stocks are a bit flat, you've got your property going well, and then you've got the cash as reserve, so you have that cornerstone. I generally believe more financial advisors should look at it. I think one of the big factors is it's very hard for a financial advisor to be held accountable for or have control within the property. If the markets are having drops in the markets and things, we can adjust the portfolio accordingly. If we've recommended getting a property and it's not the right property, you can't adjust it accordingly. But that's why advisors should engage in buyer's agents and things like that, and look at the services around them. And also making sure that the property is suitable for their needs. Some people need property that is suitable for income. They want rental returns coming in. Some people don't need rental income, and they need capital growth from the property. So it's making sure you've got that balance and it's suited to the person.
Exactly. And it all comes back to a lot of that asset selection as well, right? Where it's like, hey, let's not buy a unit in Melbourne, which is a pretty given now, obviously. But also you'd hope that if you engaged a buyer's agent or an advisor 5 years ago, they'd also be saying the same thing. And it comes back, it's like here in Brisbane, right? We've got so many different asset and selections. And I think I've talked to this about this to you before, but we had a client last year, and when he first came to us, he was like, I just want to buy someone, looks good, don't have to think about it, and it's just going to give me a decent rental income, which is fine to think about. But then he was sort of thinking around in the city, a unit somewhere, and then it's like, well, you actually look at the price growth over the past 10 years, when everything else has been doing this, the units around the city have just been up and down. So it's sort of going away from that and saying, hey, look, it might look good, but it's not necessarily going to make us the most money, right? So then we go look something on the outskirts of the city that maybe is in a more growing area, and we're going to see more capital growth, and plus we're actually already seeing a lot of that rental income come around, where it might not be as high as something in Bowen Hills or the Valley where you get the good rent for it, but that's not where you make a lot of your money. Sometimes it's actually through the capital growth of the property. So then for him, he's like, now I can add value through renovations, and now I can potentially buy another one at the end of the year. So it's all about that journey, hey, from it's not necessarily what's just the best looking thing, but it's about what's actually going to make us money and being careful in your asset selection.
That's spot on, and putting in parameters to be careful.
Exactly.
So we've seen some of the biggest rate hikes and most aggressive rate hikes in recent times. Making sure you do a sensitivity analysis. We do sensitivity analysis for clients. Right, you've purchased property. Everything looks great right now.
Yeah.
What happens if interest rates go up 2%? Can you still afford that? If you can't afford it, then you need to save up a bigger deposit, or you need to look at a different property, just to make sure that you are comfortable that you have that long-term horizon. There is no point buying a property if you've got a 6-month horizon, because you've got your stamp duties, especially investment properties, stamp duties, insurances, all that. It is a long-term play. It's not an instant income.
It's not a get-rich-quick scheme, right?
It's not.
Like a lot of people try to make it out to be. You got to be pretty careful these days.
And like you say, what you do, some of the case studies you've sent through to me, and I've seen some of the results that you've achieved. You're right on. It's not about the prettiest looking place. It's not about it's the income's there. It's about that whole picture.
Exactly.
What are you going to get? It might be there right now, but it might not be there in 2 years' time. So it's about trying to get that property for now and for the future.
Yeah, and like I said, it always comes back to the client goals, right? Some people literally just want this property in this suburb, and we can do that. But if they want a more holistic view, then you've got to take a lot more things into consideration.
Yeah, exactly.
But let me ask this to wrap up. If you could give, a younger, maybe a couple or a single person in their 20s, one piece of advice, what would you give them?
Yeah, definitely. The one piece of advice I would give is making sure you actually do research is number one. Making sure you actually take the time to look at your finances and have a longer term horizon. We live in a world which is very much talking about get rich quick schemes, whereas unfortunately that very rarely works. So it's about that longer horizon, and just because you're not rich in 6 months doesn't mean you can't have wealth in 10 years. So that would be take that longer approach with your view, not about instant wins.
Yeah, awesome. Well, you heard it here first. That's Ross Pocock, guys. I'll tag him down below. If you want to get in touch, feel free to reach out. And yeah, thanks.
No,
thanks,
I
mate.
appreciate it. Thank you for having me on. Cheers, mate.
Legend.